We begin with Chapter 23. In this chapter, we will analyze in detail the Long Iron Condor strategy. The Long Iron Condor position is used when the market outlook is neutral around the strike prices of the short options. The strategy consists of buying one put, selling another put with a higher strike price, selling one call with a higher strike price than the short put, and buying another call with a higher strike price than the previous one. All options must have the same expiration date, and the strike prices of the long options must be equidistant from the strike prices of the short options. Here we can see the risk graph of the position. What we are seeing is a graph with two axes. On the vertical axis, the profits and losses of the position are indicated, and on the horizontal axis, the stock price is indicated. It is important to mention that the graph indicates the profits and losses per share on the expiration date of the contracts, and besides, the values do not include brokerage commissions. In the Long Iron Condor strategy, the strike prices of the short options are called body. On the other hand, the strike prices of the long options are called wings. Therefore, the credit received for initiating the position is equal to the premium of the short options minus the premium of the long options. That is, the credit received is equal to the premium received minus the premium paid. Precisely, the difference between this strategy and the long condor is that when we initiate a long iron condor, we receive a credit. On the other hand, when we initiate a long condor, we place the trade at a debit. The maximum profit on this strategy is limited. The most we can make is equal to the credit received multiplied by the number of shares. On the other hand, the maximum loss that we are exposed to is also limited. The most we can lose is equal to the difference between the strike prices of the short put and long put minus the credit received multiplied by the number of shares. As we said, in the Long Iron Condor strategy, the strike prices of the short options are called body, and the strike prices of the long options are called wings. In general, all the options are out of the money. This strategy has two break-even points, a break-even point to the downside, called break-even point 1, and a break-even point to the upside, called break-even point 2. Break-even point 1 is equal to the strike price of the short put minus the credit received. On the other hand, break-even point 2 is equal to the strike price of the short call plus the credit received. The break-even points define the profit and loss zones. In our case, for stock prices lower than break-even point 1 or higher than break-even point 2, we are in a losing situation. In contrast, for stock prices between break-even point 1 and break-even point 2, we are in a profitable situation. The Long Iron Condor can be thought of as the combination of a bull put spread and a bear call spread. Continuing with the analysis, the initial margin required to open the position is equal to the 100% of the maximum loss. An increase in volatility typically hurts the position. Time decay typically helps the position. With respect to exit conditions, to close the position, we must buy the short options, that is the body, and sell the long options, that is the wings. If the stock price is higher than break-even point 1 and lower than break-even point 2, we are in a profitable situation. Otherwise, we are in a losing situation. In this graph, we can see the influence of time decay on the position. On the vertical axis, the profits and losses of the position are indicated, and on the horizontal axis, the stock price is indicated. The blue curve indicates the profits and losses at trade initiation. As we get closer to options expiration, the curve of profits and losses is like the one shown in green. And finally, at options expiration, the curve of profits and losses is the one shown in red. For this strategy, time decay typically helps the position. Let's see an example of how this strategy works. Here we are seeing the stock chart of the Microsoft company. As we can see, during the months of July, August, September, and October 2011, the stock was trading in a range between $24 and $28. In particular, for the last 2 months, the stock defined a support at $24.25 and a resistance at $27.5. As we said, during the months of July, August, September, and October 2011, Microsoft was trading in a range between $24 and $28. In particular, for the last 2 months, the stock defined a support at $24.25 and a resistance at $27.5. If we expected that the stock would stay in that range for the next few months, at that time we could have entered a Long Iron Condor. At the close of November 1st, 2011, Microsoft was trading at about $26, while the options expiring in November 2011 had a premium of 18 cents for the 24-strike puts, 38 cents for the 25-strike puts, 18 cents for the 27-strike calls, and 5 cents for the 28-strike calls. Thus, we could have bought 10 puts with a strike price of $24 and expiration in November 2011 at 18 cents, sold 10 puts with a strike price of $25 and same expiration at 38 cents, sold 10 calls with a strike price of $27 and same expiration at 18 cents, and bought 10 calls with a strike price of $28 and same expiration at 5 cents. With the 10 contracts, we would be in control of 1,000 shares. So we would have received a credit of 33 cents per share from placing the trade. That is, $330 overall. The maximum loss is given by the difference between the strike prices of the short and long puts minus the credit received multiplied by the number of shares. In our case, 25 minus 24 minus 0.33 multiplied by 1,000, which is equal to $670. This is the margin required to open the position. After initiating the trade, the stock was trading between $25.7 and $27.2 for the next 2 weeks. Finally, on November 16, 2011, it closed at $26.07. That can be seen here. We initiated the trade on November 1st, and during the next 2 weeks, the stock was trading between $25.7 and $27.2. Finally, on November 16, it closed at $26.07. At that time, the options had a premium of 1 cent for the 24-strike puts, 2 cents for the 25-strike puts, 3 cents for the 27-strike calls, and 1 cent for the 28-strike calls. If we had closed the position at that time by selling at 0.01, buying at 0.02, buying at 0.03, and selling at 0.01, we would have had a debit of 3 cents, so our profit would have been 30 cents per share, because we had received a credit of 33 cents per share from placing the trade. Thus, we would have had a total profit of $300, making a 91% return on investment in 15 days. 2 days later, on expiration Friday, November 18, the stock closed at $25.3. That can be seen here. 2 days after November 16, on the expiration date of the options, the stock closed at $25.3. At that time, all the options expired out of the money. So if we had held the position to expiration, we would have made a profit of 33 cents per share. That is, the total credit received from placing the trade. Thus, we would have had a total profit of $330, making a 100% return on investment in 17 days. Here we can see the numbers of our example. The strategy consisted of buying 10 Microsoft puts with a strike price of $24 and expiration in November 2011 at 18 cents, selling 10 puts with a strike price of $25 and same expiration at 38 cents, selling 10 calls with a strike price of $27 and same expiration at 18 cents, and buying 10 calls with a strike price of $28 and same expiration at 5 cents. That is, we placed a 24, 25, 27, 28 Long Iron Condor times 10. The credit received is equal to the premium received minus the premium paid. In our case, 0.38 plus 0.18 minus 0.18 minus 0.05, which is equal to 33 cents. Therefore, our investment is equal to 0.33 multiplied by 100, which is the cost of the strategy per contract, multiplied by 10, which is the number of Long Iron Condors we entered. That's a total of $330. This money is credited to our account. The initial margin required is equal to the 100% of the maximum loss. In our case, $670. This is the minimum amount of money that must be deposited into our account in order to open the position. The maximum profit we can make is equal to $330. That is, the total credit received from placing the trade. If we had sold at 0.01, bought at 0.02, bought at 0.03, and sold at 0.01, we would have made a profit of $300. On the other hand, the maximum loss that we are exposed to is equal to the difference between the strike prices of the short put and long put minus the credit received multiplied by the number of shares. That is $670. Regarding the break-even points, break-even point 1 is equal to the strike price of the short put minus the credit received. In our case, 25 minus 0.33, which is equal to $24.67. On the other hand, break-even point 2 is equal to the strike price of the short call plus the credit received. In our case, 27 plus 0.33, which is equal to $27.33. Here we can see the order we must enter to open the position. It is an order with 4 legs. Leg number 1 corresponds to the higher body and consists of selling 10 Microsoft calls with a strike price of $27 and expiration in November 2011. Leg number 2 corresponds to the higher wing and consists of buying 10 calls with a strike price of $28 and same expiration date. Leg number 3 corresponds to the lower body and consists of selling 10 puts with a strike price of $25 and same expiration date. Leg number 4 corresponds to the lower wing and consists of buying 10 puts with a strike price of $24 and same expiration date. The entered price is given by the difference between the selling and purchase prices, that is, the premium received minus the premium paid. In this case, 0.38 plus 0.18 minus 0.18 minus 0.05, which is equal to 33 cents. This is the money expressed per share that will be credited to our account when the order is filled. On the other hand, here is an example of the order we must enter to close the position. It is an order with 4 legs. Leg number 1 consists of buying the calls of the higher body. Leg number 2 consists of selling the calls of the higher wing. Leg number 3 consists of buying the puts of the lower body. Leg number 4 consists of selling the puts of the lower wing. The entered price is given by the difference between the purchase and selling prices. In this case, 0.02 plus 0.03 minus 0.01 minus 0.01, which is equal to 3 cents. This is the money, expressed per share, that will be debited from our account when the order is filled. Here we ended with the chapter Long Iron Condor. In the next chapter, number 24, we will analyze in detail the calendar spread strategy.